Good afternoon, folks. Welcome back. This is going to be a brief review and then a short little tutorial or amplification, if you will, of my Ict Breaker. So right away, we're looking at the dollar index. This is a weekly chart. You can see the inefficiency here between this candle's low and this candle's high. We worked up inside of that and had pretty much an indecisive candle. So it was kind of a lackluster trading session for dollar last week. This range in here, I'd like to see it prove to me that it wants to go higher or lower. And to go higher, it needs to get above the rejection block here. So the close of this candle, if it trades above that, then I believe we'll resume going higher. If we take out this low, then I'm going to look for liquidity below here. Because we're in the middle of the range being the low, the high, it's indecisive. It's not one-sided. It's not easy to see which side the marketplace is going to reach for. So when it's like this, we sit still. We try not to force our will or impose a bias that's not necessarily predetermined yet. All right, so here is daily chart. You can see again, this is that weekly fair value gap. The bodies were just outside of that range, and that's another reason why I'm electing to sit still, not really have a hard bias going into the new week here. It's also 4th of July in the United States. The volume may be affected by that greatly, so I believe the latter part of this week will be the real cleanest price action. So we'll be looking for price action post Wednesday. Daily fair value gap down here, you can see it reached into that. We mentioned that as a downside draw previously in previous commentary. And then we moved from this liquidity below this low and inefficiency. Remember, price only goes down for one of those two reasons. And it rallies back up into a short-term premium relative to high and the low, midpoint in here. The inefficiency on the weekly chart being transposed to the daily. You can see that's where we drew into. Now that's going to provide the backdrop for shorts in euro dollar and pound dollar. Here's euro dollar on the weekly chart, weekly inefficiency. Okay, basically the opposite of what we saw on dollar index, as you would expect. The consequent encroachment of this wick here, we treat wicks as a gap, just like the algorithm does. So the market saw the weekly high form right at the previous week's consequent encroachment of its premium right here. And again, indecisive weekly range, but trading down into a discount buy side and balance sell sign inefficiency, which is framed by the high of this candle and the low of that candle. So we traded down into it and then back into the weekly range. Those weekly ranges apply to the daily chart. You can see how we traded up into Friday, Thursday, Wednesday, Tuesday, high of the week. Where did it form the high of the week? In the previous week's consequent encroachment on this weekly candle. Don't take my word for it. Go into it and you'll see it right here. All right, let's drop down into an hourly chart on euro. All right, so you can see how we worked lower here. Here is that run onto the previous week's consequent encroachment on its wick on the weekly chart. Creating the high on Tuesday. If we're bearish, we have a 70% likelihood of creating the high on Tuesday. And we see it trading up into that consequent encroachment. Breaks down, finds some support at the old fair value gap, orange, in the higher time frame. Tried to rally and gave up the ghost, broke lower. So we have breaker in here. I know it looks rather sloppy, and I'll be teaching a little bit more about breakers in the latter portion of this lecture. So all of this run here, extend that over. You can see we're hitting that perfectly there, and it just so happens to be near the upper end of that old inefficiency. So we're blending a lot of things in terms of inefficiency and buy side liquidity. Buy side would be resting above this short-term high here. So we rallied above, back into a premium array, which is a breaker, trades up into it and aggressively sells off, attacking the sell side below this low and down into that low here and into that discount fair value gap. Then once we got into it, we returned quickly back up into the premium fair value gap that's shaded in orange. So I promise you, if you take the information I showed you on the higher time frame on your own charts and then drop down to these lower time frame charts like this, you'll see Euro was beautifully handled with the elements I'm teaching you in terms of short-term premium high, short-term discount low, inefficiency above the marketplace, inefficiency below the marketplace, and day of the week, and then the opposite end of the range forming here on Friday. On a 15-minute time frame, you can see that we have a very nice drop here, then the rally up. Now, all of this back and forth in here, that's not a concern for me. You might be looking at this saying, okay, well, isn't this a breaker from high to low to higher high? No. The range from this high down to that low, up to that high, all of this price action from the high to the low to the high right there, I'm ignoring all of this. This is time distortion. You have to look at the time of day when the highs are forming. The algorithm refers to time first, not just simply because there's a price run. So we're looking at high, low, higher high. This movement down here, that's where the secret sauce is, if you will. I'll get to that later on. But that down close candle right there, that is the sweet spot. Right in here, if you extend that forward, that's where it's hitting that. Now we're cutting through candles because we are not supply and demand. That's a fallacy. The market trades up into a premium relative to the range from high to low. And we're also reaching into the upper portion of this shaded orange inefficiency. Breaker, cut through candles, bang, hit it. What time of day? New York open. Aggressively runs for the sell side here and the sell side liquidity in the higher time frame and into that discount fair value gap. Once it enters that, then the algorithm pulls right back up into the middle of the range being the high and low of the week. And now we're in consolidation inside of that premium fair value gap. All right, moving right along. This is the E-mini S&P weekly chart. And I mentioned that we try to reach up into this weekly volume imbalance, and we just fell short of it. It looks like it touched it here, but I promise you it didn't get there. It got real close to it though, but it's been acting as a draw on liquidity. As you remember, the NASDAQ reached up into its volume imbalances on its weekly chart, but we were waiting for the Six Sister effect on S&P to draw this specific index higher, and we have seen it deliver like gangbusters. So bias starts on a weekly chart. We have to know where it's likely to reach for, and then what we're doing is trying to predict. Yes, unfortunately, we do try to predict. We don't react to price. We need to predict the likely expansion in the weekly chart. I'm not trying to pick the closing price. I have tools for that. We're not trying to demand that it closes on the high or the low. We don't need that. But we want to know where it's likely to expand, higher or lower. And if you look real close, there was a small little inefficiency right there between the previous week's low and this week's high. So that little inefficiency right there, the market opened, traded down into that, and then rockets up, taking out the short-term high, but drawing into this area here. Okay, so I suspect that's still probably going to be a factor for this week. On the daily chart, you can see we have this inefficiency here and this inefficiency here. Now, I sent a tweet out about a week and a half ago stating that these were the two reference points I liked. And initially, at the time of the tweet, I said I favored the low end. We went down into it. The top of the market was not called by me. I don't try to do that when we're in primary buy models. So we're looking for longs, reaching for discount, and then expanding into inefficiencies above marketplace or buy-side liquidity. The buy-side would be resting right above here, and inefficiency would be the weekly volume imbalance, both being above market price at the beginning of the week, and price drew up higher throughout the week. So each individual day, if you would have been focusing only on longs, that's what you're doing. You're filtering out in the best case scenario where the higher time frame weekly chart is suggesting price may go ultimately. We stay with that bias each day. every session we go in looking for a reason to be long when there's a buy program underway, and that's what we're seeing here. Zooming in on the daily chart, I want you to see how we were beautifully delivered into this candle's high. You see that trading right there, and perfect delivery, rallies up. And then we have this area here, which is a premium. When it was down here, it was a premium fair value gap. But if we're expecting it to go higher, my anticipation is we're going to take out this high and gravitate towards that weekly volume imbalance. So the buy program would send us into discovery of buy side and premium volume imbalance. You would grade this range with 25, 50, and 75% respective levels or gradients, and you would treat each one of them as a target. Well, we only got as far as the buy side here and just fell short of touching the low end of that weekly volume imbalance. But this right here, as we're climbing back up into this range, if you're familiar with my market maker buy and sell model and know that is not Wyckoff, this area here, that inefficiency, which we would reach for, if we're bullish, we're expecting to expand through that. That will become my inversion fair value gap. Find that in your Wyckoff textbooks. So there's our levels. We're going to show it in two sets of small little trend lines, and we'll drop down the lower time frame. Right, so we have the market trading down into the lower fair value gap, and then we have an expansion higher. And in all of this range right there, that range is the last up close candle within the low, high, lower low, which trades into what? The inefficiency. Remember these two red lines here? That's the lower discount fair value gap, the one I was telling you a week and a half ago, almost 2 weeks ago, that I favored the lower one, and the market did drop down into it. Then we have a displacement to the upside, taking out a short-term high. If you're aggressive, you can use that high. Which one do you use, ICT? Whichever one I'm trusting at the time. So if you want to be a conservative trader, demanding a lot more behind the trades, then you would use this one here. Why that one? Because it's the high between this low and this low, which is a bullish breaker. So you would expand that to the right, and as price rallies above, comes down, finds some support multiple times here, then rallies up, consolidates, takes out sell side there. Once a stop run occurs, the market should expand higher. It does, rips through that premium fair value gap that we would expect to see it trade to. And look at that. Look at the bodies respecting the high end of that inversion fair value gap. It does not need to trade down into it. It can. But these are instances where sometimes when you'll see me doing my executions, I'm recording it, I'll say it's better for these inefficiencies or that particular fair value gap to remain unfilled. We want to see this be treated as a measuring gap or a breakaway gap. So it's only necessary for me or you to see this area right in here provide support. We're seeing that in the body's close and the body's opening and then protraction. The inefficiency here doesn't look inefficient on the lower time frame hourly chart, but it was based on what? The daily chart. So you have to transpose those levels on your lower time frames. Otherwise, you'll lose all the plot, narrative, and storyline behind why price should be reacting or drawing to specific levels. So that right there would have been an area where I would add, if I was trading E-mini S&P and looking for a reason to go long and add more. Say, for instance, say you bought the breaker down here, and you wanted to see it rip through this fair value gap. Anyone that simply looks at gaps in price charts now, and they think that every inefficiency is a buy or sell, they lose the idea of knowing where price is ultimately trying to reach for, which is the number one rule I teach as my students coming in. I press that very hard as your main focus, because it's going to be the one that you're going to utilize for the rest of your career, that gives you all the comfort and confidence to know what you're doing and how you're operating, being bullish or bearish. Bias comes by understanding where the higher time frame weekly draw on liquidity is. You can't watch a video and there's nobody else out there going to show you a real shortcut, always a winner approach. It takes time understanding price action. What is it reaching for? And this is enough to warrant an expansion higher. And until we find it providing support, remember this red line here is the high of that fair value gap. Let me go back up into the daily chart. I'm going to show you this little area right here where these two candles right there are occurring. and finding support at the high end, it's this. It's that level right there, which is the high of that fair value gap. And we're expecting price to go higher. So we're not looking for it to go up here to go down. That's not the 2022 model. Okay, we're using this as a stepping stone or a rung on the ladder to provide us a reason to see more injection of higher prices. So we see that occurring right there. So that's a really good signature. Even if I didn't take a partial entry and scaling in with a, like a pyramiding position, by seeing that, that comforts me in terms of being on side. So I can anticipate the market reaching up into that buy side liquidity over there. And it reaches up into it, and look at the bodies respecting what? That old high. Yes, we wick through it. Yes, we fall just short of the weekly volume imbalance, but we're not trying to demand that it gets there. We offer ourselves up the opportunity for a best case scenario should it trade there. But we're open to the idea that it may need to do that the following week because it's doing this on a Friday. All right, S&P 15-minute candlestick. You can see a really good illustration of that run into that inversion fair value gap. Hits it and rallies. Inefficiency, trades down into it here at the open, rips higher, consolidates, trades higher once more, digs into, and I showed you execution on Twitter, and the link will be obviously shared in either the comment section, which I'll only be the one commenting. And yes, I see your comments when you leave them, but it's personal for me. I'm not trying to broadcast your adoration for me. I don't need to share that, but I enjoy reading them. It rips into that buy side there, and then comes all the way back down into the inefficiency here with this cluster of order flow right there. And that's where we settle on the day. So on the 15-minute time frame, if you look at this, we have obviously been looking for higher prices on NASDAQ and on ES, and I'm focusing primarily on ES because I've been teaching conceptually the six sister concept that I have, and we've already seen the upside leadership by NASDAQ. So we have been focusing on ES to show how that particular index has been drawn higher in sympathy, trying to catch up to what was delivered with the run higher in NASDAQ. So because we're bullish, we want to look for periods where there is accumulation of longs. So we can see what? We have a low and a lower low in ES. On NASDAQ, we're seeing a divergence there. NASDAQ saying, no, I'm not willing to make that lower low like we did in S&P, respectively. So this is SMT divergence, and we would expect price to go higher. If we were looking for the market to trade with the leadership issue, okay, in other words, say the NASDAQ hadn't already established its dominance higher, but it has been for weeks, and it did this divergence here, then I would have been trading NASDAQ. But because NASDAQ has already done a lot of upside and I'm trading the six sister approach, the fact that we have this divergence down here, which is a lower low, but not lower low in NASDAQ, you're probably wondering, why wouldn't you trade in NASDAQ? You're not incorrect by doing that. But I'm teaching you by using the six sister approach that by sympathy, this is going to try to trade higher in a little bit more, I don't want to say stronger, but more reliable, because NASDAQ has already done its upside delivery. So the S&P is basically going to have its better days ahead, which is what we saw last week on the upside. So I would view this low being taken out there as a stop run, and that's how you trust a turtle soup entry, okay? Buying sell stops. And this would be simply just buying the stronger leadership issue at the time, and you wouldn't be incorrect by doing it because you can see it does, in fact, rally. But look at the delivery of price in comparison between the two. A lot more willingness to show it wants to go higher, because look, we rallied higher and then come back down and touched the high end of that fair value gap, which is this red level here. And now we also have that breaker. Extending it forward inside of that range, we can be buying, has a lot of support of discount behind this entry area here. And at the same time, look what's occurring in NASDAQ. It's really muddy, meaning that it's not so sure footing compared to that one, where we have a higher low here. We don't see that higher low here. It's a sloppy consolidation. This one here rips higher, comes back, and really wants to go higher. One more time, touch to the inversion fair value gap, and it's the low of the bullish breaker, and it rips higher and consolidates the rest of the day. And then we have another confirmation that we're looking for a higher delivery in price, low, lower low. So this is a stop run below those lows here. So that's a run on sell side liquidity, and it touches the breaker, bullish breaker. At the same time, NASDAQ is unwilling to make a lower low. That's SMT. It's telling you that there's accumulation, there's a cracking correlation, and this will never stop working. The markets will always have these types of inefficiencies when prices are running out highs and lows, respectively. If you have a bias, if you know you're looking for higher prices, and you see these confirmations, that's what this is. This is not a timing tool. It's not a selection tool. It's a confirmation. Okay, because we're using SMT as a qualifier to indicate that we are in fact on side by trying to be bullish. And we can use this idea to, if you're a turtle soup type trader, if you're trying to train yourself to buy sell stops or sell buy stops, it means you're doing a run against the existing pending orders above the marketplace or below the marketplace. Without this insight, without the understanding of where the market's going to go to, you're going to find that trading a turtle soup pattern or a false breakout and trading it in the opposite direction, it's going to be very difficult for you to do that, and it's scary. But this is how you learn how to do it, and you have to do months of this type of analysis. Then you can go in there and just buy sell stops and sell buy stops, and you've seen me do executions of that, recording it. The primary function of SMT behind this is supporting the idea that we are in a buy program, and it's okay to keep focusing on longs for ES. So the market goes higher, again, another area here, higher low, lower low. So what is this? This is reaching for the relative equal lows for the sell side. So this is a run on sell side liquidity. So a trader using NASDAQ, they could use that as a long entry. Same here, buying sell side, but we're seeing what relative strength now show up in ES. Higher low, lower low. It's the time of the week where the market wants to reach for its finale. It's reaching high up into the June 16, 2023 high, which is this level right here, and gravitating towards that weekly volume imbalance, which is that blue shaded area here. It's not showing the entire range because I want to have all the details being shown here. But again, look how it's treating the top end of that inversion fair value gap on the daily chart. Hits it and then rips higher, reaching into that buy side liquidity above June 16, 2023's high. And then the added benefit of knowing that that weekly volume imbalance shaded in blue, that's a large magnet for the algorithm to want to reach up into that because it's inefficiency. So when we're down here, in here, over here, in here, they're all points of reference for you to either be long, add to existing positions if you're short-term or a swing trader, or just confirming that you're on side for bias, and then you can look for lower time frame order flow, like for a silver bullet in the 10 o'clock to 11 o'clock morning hour, or 2 p.m. to 3 p.m. afternoon silver bullet. So there's a lot of things you can do to work with this information, but I leave it to you to determine how you're going to use it for your particular model. And you can use the multiplier of your choice. It could be a optimal trade entry. It could be a bullish order block that you're trading on. You could be buying sell side liquidity. You can be doing inversion fair value gaps, regular fair value gaps, institutional order flow entry drills. The list is endless in terms of what it is that you want to trade. And whatever that multiplier is, which is a PV array that I've taught, that's your entry model. But this is the framework to determine where the market's going to go and when it's going to be confirming to you that it wants to go higher. All right, I'm going to take all this other extra stuff off here so you can see the divergences. Lower, higher. Lower, higher. Higher, lower. All indicating that it wants to go higher. Now, many times my students, when they first see an instruction or lecture video about SMT, they think that they need to go into the charts and look for the discrepancy or difference between lower low and then there's no lower low here, okay, that means they can go long. That's not how you use SMT. It is a qualifier, okay? It just gives you confirmation that order flow is probably not in the direction that you see the lower low being made when a higher low is being formed in a market that you're anticipating to be bullish anyway. So we were looking for this area up here for weeks. We've been calling this months, actually, a draw up here for ES. So we've been bullish on ES for months. And finally, we just fell short of it here, and I'm not convinced that we had the high form here. So we're likely to see it draw up into that going into this week's trading. All right, so here is the 5-minute chart on ES, and I'm showing it in regular trading hours. So that way we're showing that gap right here. So this is where we settled on Thursday and where we opened up at 9:30 on Friday's trading, regular trading hours. So if we add the details in here, I sent a tweet out on June 30th, 2023 at 9:52 a.m. This is always in New York local time. And right there is the candle I made that post on Twitter. I said that this high, 44.93 3/4, that high right there is the daily June 16, 2023 high. I said that that buy side is juicy, meaning that it's going to want to gravitate towards that. So how would you use that information? Well, you can use it with fair value gaps, bullish order blocks, buying sell side liquidity. Below this low is what? Sell side. So you could be a buyer down there. Well, wait a minute, ICT. Didn't you say that these opening range gaps, they can draw price down in? Yes. But there's also tendencies for the market to have these large range gaps because it's in a hurry to get somewhere. Where is it in a hurry to get to? That weekly volume imbalance in shaded blue and the buy side liquidity I told you right here. So we dropped down ahead of lunch in New York lunch hour. We took out sell side there, rallied, created a fair value gap. That's what I'm showing you here, right there. Okay, market drops down into that perfectly, and then rallies away and attacks what? This area of relative equal highs. So this is your first initial buy side liquidity. Then the larger pool of liquidity is here on the daily chart on June 16, 2023, that daily high. You can see we gravitated towards there. We worked around that level and finally punched up and just fell short of reaching into that weekly volume imbalance. And then finally, at the last portion of the day, the market rips back into the range and trades into this inefficiency between these two 5-minute candles, which is a 10-minute fair value gap. Zooming in here on a 5-minute chart, again, here's where I said that we would be looking for a draw to 44.93.75 buy side. This level right here is that high on the daily chart. The market gravitates from this point here all the way up into that level there. So you do not look for shorts here. You don't lose your mind and become fearful because we have a huge opening range gap on Friday with unfinished business that June 16th has buy side. It wanted it. I indicated that here. No other time frame on Friday did I point to a lower target. I did not say another level that failed to hit. Okay, we talked about this as a draw on liquidity, that weekly volume imbalance, but I gave a very specific level for targeting. So when we look for the directional bias to come into effect, we're looking for higher prices. We did get a stop run on sell side there, and then we've seen price go higher in inefficiency. It comes back down into it. Now we're in lunch. So where's the buy side? Above here. So above those relative equal highs, that's what this is right there. We're down in a 1-minute chart now. So 44.87.5, that's buy side. Here is that 5-minute fair value gap. I will be teaching and talking about this coming week. The 11:50 to 12:10 macro. It's a time of day where the algorithm will begin a price run. It runs for liquidity. Sell side is here. It drops down right there and then goes higher. Let me take you back up to the 5 minutes. That way you know where you're at and get your bearings. We're looking at this run here and drop down between these two blue lines, targeting that initially, but ultimately above June 16, 2023. So those levels here, we're going to look at all of this price action and this run up here. Right now it's on a 5-minute chart. looking at it now on a 1 minute chart, it looks like this. Here's the relative equal highs. The drop down below the low where the sell side is, and then at 11:50 to 12:10, the algorithm will begin its buy model. It will run higher, trades into the inefficiency. It doesn't look like an inefficiency here on a 1 minute chart, does it? Which is the reason why you have to cycle through time frames. You have to be able to go through a 5, 4, 3, 2, 1